As we continue to wind down 2022 and look ahead to the new year, our focus, much like the Fed's, remains on inflation. And according to our next guest, as inflation improves, more financial conditions loosen, making the Fed's job even harder here. So joining us now to break down all of this and much more is Jason Katz, UBS Managing Director and Private Wealth Advisor. Jason, good to have you here with us on this holiday week. Given what we've seen in the markets leading into these final weeks of the year, all the focus now is clearly on 2023 and just what the Fed's pathway may be. What are your biggest expectations and the tenor that the Fed is going to strike going forward once we get into the new year?
Yeah, look, if you annualize inflation over the last 3 months, we're actually looking at headline inflation at around 3.5%. But that's not the 2% inflation target. So we have this catch-22. The reason manufacturing inflation is down is the reason service inflation's up. We're not at home buying stuff, we're getting out and doing things. And the real catch-22 is the more that headline inflation improves, the more financial conditions loosen. And the more that those conditions ease, it makes the Fed's job all the more harder. So there was no surprise of what was said or done for that matter at the Fed meeting. And the market's reaction suggests that investors are getting the memo. The Fed is saying what it means and meaning what it says, and they're unapologetically hawkish. And I don't think they're going to relent on tighter policy until inflation's under control. What they may relent on is what that target ends up being. It may be a 3.5% target, not necessarily 2%. We shall see.
Jason, maybe I'm getting inspired by that really cool bull on your wall there, which I'm going to take this offline. I need to know where you got that thing. But what stocks should people be bullish on after a very challenging year this year?
Yeah, I mean, listen, you want to find industries that are thematic in nature. And I think there's some investable areas, regardless of whether we have this recession, how deep and how long it lasts. You take, what's happened with the war in Ukraine and the lessons learned there. Companies aren't as focused right now on price and efficiency. What are they focused on? Safety. So you think about energy, think about cybersecurity, or you think about food and agriculture. Food, for that matter, getting clean water to polluted areas, or companies that boost the agricultural yield by making vertical farms. So you're looking at areas that, regardless of whether the war persists or inflation rages, are going to continue to thrive. Cybersecurity is another incredibly investable area. We can't be beholden to our enemies for our energy, our food, and now we need to protect our companies, our governments, and our schools. And cyber spending is a prerequisite for every business leader I speak to.
Jason, I'm going to take the flip side of this. What do you think? What are you avoiding at all costs going into 2023?
Well, I'm avoiding some of the really crowded trades. For instance, a lot of the defensive areas like consumer staples or utilities, for that matter. Utilities are very bond-like. And listen, I manage money for individual high net worth investors, and everyone was in the pursuit for safety and yield, especially recently. And the valuation in an industry like utilities that doesn't really grow earnings and are regulated are hypersensitive to moves in rates. And should the 10-year get back over 4.5%, there's meaningful downside there.
What type of shift would you need to see in not just the Fed's policy, but perhaps in the broader environment for technology, which has been a sector that has led us through bull rallies and bull markets in the past, for that to be a kind of reconcilable decision for somebody to make within their portfolio?
Look, investors are a creature of habit. And having done this for 3 decades, I see people have the muscle memory of buying what they're familiar with and what has worked. I'm not saying to abandon tech, or big tech for that matter, but 60% of their earnings come from overseas. Any strength in the dollar or any weakness overseas or weakness in consumer ad spending just don't bode well for that industry. So for that to get investable, growth can't come down as much as feared. And if it doesn't, then I think you could definitely see a resurge in technology. But there are far better, more investable areas at this point. Fixed income, being one of them.
Point well taken. Jason Katz, UBS Managing Director and Private Wealth Advisor. Good to see you. Happy holidays.
You too.